Chapter 15, Qualified Plan Investments. Lecture for the Test Bank. True, false. Every qualified plan must identify a named fiduciary in the plan document. The answer is true. There must be a named fiduciary for the employees to understand who holds the responsibility as a fiduciary. The answer is true. Question 2. Fiduciary rules indicate the specific responsibilities of each person involved in designing and maintaining a qualified plan. That is false. There are not specific responsibilities in total, but there are general responsibilities in order for the qualified plan to indicate who is a fiduciary. Question 3. Following ERISA guidelines for qualified plan investments generally results in selecting from a rather narrow range of investment strategies. The answer is false. There are broad ranges of investments which may be chosen under ERISA guidelines for qualified plans. Question 4. Fiduciaries cannot delegate financial responsibilities and in turn avoid direct responsibility for performing the duty. The answer is false. They may delegate fiduciary responsibility as long as those individuals to whom receive the delegation are handling their fiduciary responsibilities. Question 5. The plan is allowed to pay a reasonable fee for legal, accounting, or other services performed by a party in interest. This is true. They are allowed to pay reasonable fees, period. Multiple choice question number 1. The fiduciary responsibility net includes any person who exercises any discretionary authority or control over plan management. That makes sense. Exercises any control over plan asset management. That would be true. Renders investment advice for compensation. Yes. And has discretionary authority or responsibility in plan administration. That is true. So the answer is D. All of the items are true. Number 2. Which of the following best identifies the term used to identify a fiduciary's general investment responsibility? Prudent man requirement, trusted advisor requirement, diversification requirement, investment policy requirement. And the answer is A, prudent man requirement. Number 3, in general terms, a number of transactions are prohibited between the plan and certain people, including a fiduciary, a person providing service to the plan, an employer, an owner, or an employee organization. Which one of the following correctly identifies the term used to describe these people? A, employee in general, B, owner of a 5% or more interest, C, party in interest, D, a Department of Labor administrator. And the answer is C, party in interest. The question asks for in general terms. The answer is C, a party in interest. Question 4. Which of the following is a term used to identify income of a tax-exempt organization that may be subject to taxation? And if you recall, the book mentions the unrelated business taxable income is the term to identify income of a tax-exempt organization that may be subject to taxation. UBIT, unrelated business taxable income. Question 5. A fiduciary typically includes which of the following? The employer, absolutely. The retirement plan trustee, for sure. An accountant who only renders actuarial services for the retirement plan. No, they are not fiduciaries. So the answer is E, only A and B. The accountant who renders the services must render appropriate services, but they are not fiduciaries. The employer, or the retirement plan trustee who oversees the accountant providing actuarial services, is the true fiduciary. So the answer is E, only A and B. Question number 6. The duties of fiduciaries include all of the following except A, act with the care, skill, prudence, and diligence under the prevailing circumstances that a prudent man would act in a like capacity. Well, that's the definition of the prudent man, so that is true. B, select moderate to high-risk investments that will maximize gains in the plan. Well, that's not true. I don't believe it is the fiduciary's responsibility to select the investments. It is the employee's responsibility. C, follow the provisions of the documents governing the plan, unless inconsistent with ERISA provisions. That makes sense. D, act for the exclusive purpose of providing benefits to participants and their beneficiaries. Well, that is true. So, E, all of the above are duties of fiduciaries, is not true. Therefore, except the answer would be B. That is not the role and the duty of the fiduciary. Adequate liquidity is one of several specific investment objectives in a qualified plan. Which of the following types of assets offers the most liquidity? Well, of all the choices, common stock traded on the stock market is the most liquid. That does not mean the other items cannot be included as investments, but liquidity is one of the specific investment objectives in a qualified plan. Therefore, common stock would be one of the choices because it does provide liquidity. Question 9. Most of the ERISA investment rules are intended to, and if we think about ERISA, it is intended to protect the retirement of the individuals. So A, prevent the investment from too much risk, is the best choice. D, prohibit transactions of any kind. Although there are prohibited transactions, that is not the rule, the intended rules of ERISA. So the answer is A. Question 10. Walter Graves, owner of Graves Excavating, wants to deposit employer stock in a qualified individual account plan. The stock is not publicly traded. Which of the following true for Walter? A, ERISA limits such contributions to 10% of fair market value of the assets. B, employer stock will provide the qualified plan with ample liquidity. I don't think so. Employer stock is not publicly traded. Walter could use a profit-sharing plan to accomplish his objective. I believe so. A and C. The answer is C. Walter could use a profit-sharing plan to accomplish his objectives. Item A, ERISA limits such contributions. It would be 50% of the value of the assets, not 10%. Question 11. I'll pause the video for you to read the question and the answer choices. Please pause the video now. The question addresses fiduciary responsibility. Item B, Sarah should be sure that her liability insurance covers all liabilities that arise out of breach of fiduciary responsibility, is a good thing to do. And C, the rules do allow Sarah to reimburse the plan trustee for any losses the trustee might occur as a result of performing fiduciary duties. Item A, she has not freed herself from all of the responsibilities of the plan trustee. she has the responsibility fiduciary of overseeing the trustee. So the correct answer is E. Both B and C is appropriate. Question 12. I'll pause the recording. Please pause now and read the question. And the answer to question 12 would be false. This arrangement would be a prohibited transaction under ERISA in that the owner is self-dealing with the benefit plan, and that is a prohibited transaction. Question 13. The IRS caught the plan trustee for Hopper Manufacturing violating the prohibited transaction rules. Hopper Manufacturing, A, must pay an initial penalty equal 5% of the amount involved. That is true. Must pay a 100% penalty if the transaction is not corrected within the time limit set by the IRS. That is true. May face penalties for breach of fiduciary responsibility. That is true. Number E is only A and B. Well, that's not true because they also will face penalties for breach. So the answer D, all of the above, is the correct answer.